If you walked into a central bank vault today, you would not hear alarms. You would not see soldiers. You would not see panic on television. You would see silence, steel doors, concrete walls, and behind them, cold, not coins, not jewelry, not nostalgia, strategy. Because while the world argues about inflation, interest rates, and digital currencies, governments are quietly buying metal. And they are buying it faster than at any time since the collapse of Bretton Woods. This is not coincidence. This is not tradition. This is preparation. To understand why, we go back to 1944, a hotel in New Hampshire. Delegates from 44 nations. The Second World War was not yet over. But the next war, the monetary one, had already begun. The agreement they signed gave the United States something no empire had ever held before: control of the world's reserve currency. The dollar would be backed by gold, and every other currency would be backed by the dollar. Gold did not disappear. It moved to Fort Knox. For decades, the system held, until 1971, when the United States closed the gold window and severed the final link between paper and metal. From that moment forward, the global system ran on trust. Not gold, not silver, not hard collateral. Trust. And for 50 years, that trust worked. But trust is strongest in calm weather. It weakens during storms. In 2014, storm began. When Russia annexed Crimea, sanctions followed. Bank accounts were frozen. Assets were seized. Dollar access became conditional. The message to the world was clear. If you rely on another nation's currency, you rely on their permission. That message was heard in Moscow. It was also heard in Beijing. Russia responded first. It sold United States Treasury bonds. It bought gold. Tons of it. Year after year, the Russian central bank accumulated metal. By 2022, gold made up more than 20% of Russia's reserves. Not for decoration, for insulation. Because gold cannot be frozen by a foreign government. It cannot be deleted from a database. It does not require a clearinghouse. It simply sits and waits. China moved more slowly, more quietly. Officially, it reports just over 2,000 metric tons. But China is the world's largest gold miner, the largest importer, and much of its domestic production never leaves its borders. For years, Beijing would go silent. No updates, no announcements. Then suddenly, a revision upward. Hundreds of tons added. Since 2022, China has been buying consistently. Month after month. No speeches, no headlines, just accumulation. And it is not just Russia and China. Turkey, India, Poland, Singapore. Central banks globally purchased more gold in 2022 and 2023 than at any time in modern recorded history. Why? Because something changed. In 2022, over $300 billion of Russia's foreign reserves were frozen. Not seized physically, frozen digitally. For the first time in modern history, a major global power learned that its reserves were not fully sovereign. They were conditional, and every other central bank in the world watched. Gold suddenly looked different. It was not an investment. It was neutral collateral. It carried no counterparty risk, no sanction risk, no political clause. And when uncertainty rises, nations do not buy promises. They buy insurance. Gold is insurance against a fractured world. Now here is the deeper shift. The United States still holds over 8,000 metric tons. More than any other country. Germany, Italy, and France hold thousands more. The West still dominates total holdings. This is not a story of collapse. It is a story of repositioning. The world is not abandoning the dollar. It is hedging against dependency. And that difference matters. Because this is not a gold rush. It's old rebalancing. The system built in 1944 is still standing. But cracks are forming. Trade is being settled in alternative currencies. Energy contracts are diversifying. Regional alliances are strengthening. And beneath all of it, metal is being stacked. Quietly, carefully, deliberately. This is not about returning to the gold standard. It is about reducing vulnerability. Because in a world of sanctions, currency weaponization, and geopolitical rivalry, the only reserve asset that requires no permission is gold. And this silent accumulation may define the next monetary era. But to understand where this leads, we must look at what happens when trust fractures completely. Because history has shown us before what happens when paper promises lose their anchor. Trust is invisible. You cannot measure it. You cannot weigh it. You cannot store it in a vault. But it is the most valuable asset in the global financial system. The dollar works because people believe it works. Nations hold it. Corporations invoice in it. Oil is priced in it. Debt is issued in it. Not because they are forced to, but because it is liquid, stable, deep, predictable. That depth is the real power. The United States Treasury market is the largest and most liquid bond market on earth. If a central bank needs to move $10 billion tomorrow, it can, quietly, instantly, without moving the price. Gold cannot do that. Gold is stable, but it is not elastic. It does not generate yield. It does not settle global trade at scale. It does not finance supply chains. It protects. It does not power. That distinction matters, because when nations buy gold, they are not replacing the dollar. They are building a cushion. And cushions are used when you expect turbulence. The question is not, will the dollar collapse? The real question is, what happens if the dollar becomes less trusted than it was? There is a difference between dominance and dependency. For 70 years, the United States provided security, guarantees, open capital markets, deep liquidity, a stable rule of law. In return, the world recycled dollars back into United States debt. That recycling kept borrowing costs low. It funded deficits. It supported global trade. It was a feedback loop. But every system has stress points: sanctions, asset freezes, trade wars, regional currency blocks. Each event chips away, not at usage, but at perception, and perception moves slowly, until it moves all at once. There is talk of a gold-backed BRICS currency. It sounds dramatic, but think carefully. A gold-backed currency requires fixed convertibility, massive transparency, and surrendering monetary flexibility. That means if your economy contracts, you cannot print freely. If your banks wobble, you cannot inject liquidity at will. Gold backing is discipline, but discipline is politically painful. That is why every major economy abandoned the gold standard. Not because gold failed, because flexibility was more powerful. So what is actually happening? Not a return to gold, not a collapse of the dollar, but a multipolar reserve system. Energy trades increasingly in local currencies. Regional settlement systems expand. Central banks diversify reserves. Instead of 70% dollar reliance, maybe it becomes 55%. Instead of gold being 10% of reserves, maybe it becomes 18%. These are slow shifts. But slow shifts change power over decades. Gold does not overthrow systems. It signals anxiety within them. And here is the uncomfortable truth. The dollar still has advantages no competitor can replicate. A unified bond market, military backing, institutional depth, legal enforcement. China cannot yet offer full capital mobility. Russia cannot offer deep financial liquidity. The Eurozone lacks political unity. So the dollar remains central. But central does not mean unchallenged. The world is not preparing for collapse. It is preparing for fragmentation. A world where trade corridors split, where alliances harden, where reserves are diversified, not for profit, but for protection. And in that world, gold becomes the neutral referee. It does not belong to NATO. It does not belong to BRCs. It does not belong to any flag. It belongs to whoever holds it. That is why vaults are filling. Not because governments expect apocalypse, but because they understand cycles. Every monetary era eventually adjusts. The British pound ruled before the dollar. It did not vanish overnight. It eroded, gradually, structurally, predictably. The dollar is not collapsing. It is aging. And aging systems invite hedges. Gold is that hedge. The silent insurance policy of sovereign nations. The real story is not about a new gold standard. It is about optionality. When nations hold gold, they are buying flexibility, the ability to pivot, to negotiate, to withstand sanctions, to survive volatility. And if trust fractures further, gold will not replace the dollar. But it will matter more than it has in decades. Because when paper confidence weakens, metal confidence strengthens. The vault doors are not closing, they are preparing. And the world is watching, quietly, very quietly.